Good morning and welcome to Financial Accounting for the Spring 2022 semester. Today we will be hopefully finishing up Chapter 1 if we are able to get through the remaining material. We'll see by the end of class today. If we do not finish the exercises, we'll talk about what might change. But assuming we finish Chapter 1 as scheduled today, then the Chapter 1 exercises should be submitted by the end of the day today. We will have talked about all of them and done most of them together. Then, as you're getting the feel for the flow of the requirements for class, if we look ahead to our next class day, the last day of January, you can see that we have 3 things due. That's an unusual day. We usually have something, 1 or 2 things due every day. But Monday, because you still may need to choose the company for your annual report project, that should be done no later than Monday. After Monday, I will start reviewing those and sending notes to people who need to choose a different company or had not yet chosen a company. So ideally, you choose your own company. But I don't wait too long after the due date. If you haven't chosen a company and you still don't choose a company when you get the email from me, then I will choose a company, assign a company to you, because you do need to have one for the projects. There are 5 mini projects throughout the semester. And as I explained on the first day of class, the company that you're going to choose now is the company that you will use for almost all of those chapters. There are 2 chapters, I believe it's 4 and 14, that require you to use a specific company that the instructions tell you, use this company. The other chapters say, choose a company, but you're not choosing a company for each chapter. You are going to use the company that you have approved starting next week. So that's the company you will use for every chapter for the project, unless it specifically says to use this company, use one specific company. Then it does that twice. We'll talk about the project more when it gets a little closer, once we get into February. But for now, it's important that you get a company chosen and approved. The first project is not due until February 20th. So probably this week, the week of the 7th, we'll talk a little bit more about that project and what you should be doing. Okay, so other things that are due next week, because we're finishing the chapter hopefully today, then the Chapter 1 problem, which is done outside of class, is due on Monday. And so it's the very next class day after we finish the chapter. Also on Monday, we'll be starting Chapter 2. And so the day we start the chapter, the pre-quiz on that chapter is always due. Questions about any of that? All right. So without further ado, good morning, Marquise. Let me know if you are here. So without further ado, we are going to review what we talked about last class. The most important thing that we talked about last class is what's on the screen right now, and that is the fundamental accounting equation, or more simply, the accounting equation. You can see it in bold print on your screen. Assets equals liabilities plus stockholders' equity. We pointed out that this is an equation, which means the 2 sides always must be equal. It is an equation. Assets are things that you own or control that will help you to generate revenues or make money for your company. Liabilities represent amounts that you owe to entities outside your company. And stockholders' equity represents the claims to the company by the owners of that company. So it is very, very important that you remember that equation and you know how to use it. What we're going to be talking about today is how transactions affect this equation, how we report that. So as we move ahead to the new material, does anyone have anything you want to ask about from last class? I mean, we talked about lots of other things. We talked about how business is organized, the three main types of business organization. We said we are going to be focusing on corporations. We talked about service, merchandising, and manufacturing companies and how we're really going to be focused on merchandising companies for this semester. Lots of other things we talked about, but this is the key piece to know from last class. So we also, last class, started introducing some account titles. So we know that an account is the smallest unit of storage within our accounting records. The account title is going to be short and sweet, you know, a word or just a couple words, but enough information in those word or few words that we know what that account might be used for. As we go through the rest of the semester, we will continue to encounter typical account titles. So we cannot possibly cover every single account title that every single company in the world might use, but we focus in on the general types of accounts. And the idea is you're learning the principles of accounting, and you can then expand what you know and apply it to new situations because you'll understand why we do things. That you're not just doing them by rote because, well, that's the way I was taught. So we know that the accounting equation must stay in balance. So if you think about it like a scale or a balance, you have the same weight or the same dollars, because we talked about money measure last time. We're going to denominate all of our transactions in dollars. So if you think about everything being measured in dollars, if we have assets on one side and liabilities and equity on the other side, and they have to stay in balance, if our assets go up, our liabilities and equity must also go up. If one asset goes up, something on the other side must go up, or maybe a different asset goes down. So as we talked our way through these next few exercises, we start talking about how transactions affect the accounting equation. And again, we're starting with the general without talking about specifics. And in chapter 2 next week, we'll be looking much more specifically, okay, how do we record that transaction? But for now, we're going to be recognizing that something is a transaction, and in general, what would that look like in our accounting records? Start with the general, move to the more specific, more detailed information. So let's look at our first exercise. We are in See Now, exercise, the chapter 1 exercises. We did 1, 2, and 3 together last class, and so we're starting with exercise 4. If you had access already to See Now on Monday, you should be able to just reopen that same assignment and continue to work. Is there anyone who accidentally hit submit for grading last time and you need me to reopen those? If you do, speak now and I can pause the recording and take care of that for you so you aren't doing double duty later. You definitely don't want to hit save and submit for grading until you have completed the assignment, at least to the extent that you are planning to do so. You can tell that for mine, because I'm not a student, I'm not able to save my work. So I can't go back the next class and show you what we had done in the past, although it is all on the video. So if you need to review something, please first go to the video and take a look at that. Because they are on YouTube, you can fast forward and rewind and find the position that you want or roughly where you want to be, rather than having to watch the whole thing again. Okay, so here we are on exercise 4, As I said before class started, if you do not yet have Cengage access, the sooner you can get that, the better. If you're having any trouble with that, please reach out to me by email after class and let me know that you're having some kind of an issue. The longer it goes without access, the more behind you will get. So we're in exercise 4, and you can see we're looking at effects of transactions on the accounting equation. So I've given you my definition of a transaction last class. A transaction is anything that affects the financial position of the company. In other words, something in our assets, liabilities, and/or equity changes because of this transaction. It affects our financial position. So there are lots of events that happen in the life of a business that are super important, but may not be transactions that need to be recorded in our accounting records. An example that for whatever reason always springs to mind for me is maybe you have an open position. Maybe you're expanding or you've had some turnover in your staff and you need to hire a new employee. And so you put the word out and someone comes in and applies and is a good candidate. We call them and they come in for the face-to-face interview and so on. All of that is really important because we have a position we're trying to fill, we're trying to get qualified staff onto our payroll, but none of that affected the financial position of our company, at least not yet. And so not every event in the life of a business reaches the level of a transaction. So when we're looking at any of these kinds of what we call transaction analysis, that's the first question you're going to be asking yourself is this a transaction at all? Is it something that needs to be recorded? If it is something that needs to be recorded, there are 3 questions that we have to answer. And we'll come back to these in chapter 2. Right now, as I said, we're really looking at the general picture. But in chapter 2, we'll be looking at these 3 questions. So just to plant these in your mind, recognition. Is this a transaction at all? If so, we need to recognize it. We need to record it in our records. And recognition goes a little bit farther than that and says, okay, we know it needs to be recorded. What date do we put on it? When did it happen? When is it effective? The second question is valuation. How much? And as you know, we're denominating everything in dollars, and so we're saying what dollar amount should be recorded. Sometimes it's really easy to know that answer, and sometimes it's not as straightforward, and sometimes we even need to estimate. We don't have an exact amount, but we have to estimate how much that would be and do the best we can with the information that we have. The reason sometimes we have to estimate is, as we discussed last class, corporations have a potentially unlimited life. And so they may have transactions that span multiple time periods that might go across a month or 3 months or 6 months or a year before those are done. And so we have that concept of going concern, company might keep going, but also periodicity, which is we have to report on what's happening now because decision makers need that information in a timely fashion. So sometimes we have to exchange the perfection, the perfect number, the exact number for timeliness, because it's more important that we get the word out, that we publish our information even before we know the exact numbers. And so sometimes the valuation is very clear and sometimes it's an estimate. And you'll see that in future chapters. The last question we have to answer is classification. So we talked about the fundamental accounting equation really being like a scale, and the 2 sides have to be equal. So if one side changes, the other side also has to change to stay in balance. If one goes up, the other has to go up. If one goes down, the other has to go down. They have to stay in balance. So the reason I said that classification is which accounts, plural, with an S on the end, is because every single transaction must affect at least 2 accounts. It has to. Because if an asset is affected, then a liability or an equity account is also going to be affected, or another asset will be affected. Every transaction must affect at least 2 accounts. And the classification question is which 2 or sometimes more accounts will be affected. So those are the 3 important questions that as we start talking about this transaction analysis, we're going to keep those in mind, answering those questions for every single transaction. If it's a transaction, what date, what amount, which accounts. Let's look at our exercise though, unless there are questions. Letter A says, a vacant lot acquired for $115,000 is sold for $298,000 in cash. What is the effect of the sale on the total amount of the assets, liability, and equity? If there is no change, select no change from the drop down and then enter a 0 in the amount box. Okay, so let's think about what happened here. So before this occurred, before this event occurred, we had a vacant lot. After the event, we no longer have the vacant lot, but we have all that cash that we didn't have before. So in essence, we made money, right? We had a gain when we sold that land. The same thing, of course, could happen if we owned any asset, including investments. We could sell them for more than we paid for them and realize a gain. Is this a transaction? Did something change in our financial picture? Yes. So let's see what happened. Our land, put some notes down here. So land is an asset account. It's something that we own that was going to help us run our business. The land went down by $115,000. Land is an asset. So at first blush, our assets went down. But what else happened? What do we have now that we didn't have before? Cash. So our cash is also an asset. Our cash went up by $298,000. So if we look at those 2 pieces together, one asset went down, another asset went up. Whoops, sorry, I'm just getting my calculator open here. And so the net increase in our assets was $183,000. Does everyone agree with that? Anyone with questions on where that came from? One asset went down, another asset went up. Net increase 180,000. So I can go ahead and put that in here. Our total assets increased by 183,000. So if the assets on this side of the equation went up by 183, then we have 2 choices. Either another asset we haven't considered yet went down by that same amount, or a liability or an equity went up by that same amount. So liabilities mean we owe someone money. After this transaction occurred, do we owe anyone money that we didn't owe them before? No. So I'm going to say that there was no change to liabilities. And as directed in the instructions, I'm going to say that the amount was 0. No change, 0. So we're left with 2 options. Did another asset go down because of this transaction, or did the owner's share of the company go up? I would say the owner's share went up. Yeah, absolutely. I totally agree with that. The owner's share would go up by 183,000. The company just made money by selling that land for more than they had invested in it in the first place. Does this make sense? So to analyze this transaction, I don't want to get too far ahead of ourselves, but to analyze this, we'd be doing entering a transaction that affects land, making it go down by 115, affects cash, having it go up by 298, and then some equity account, and we'll get to that later, some equity account is going to go up by 183. And as long as we do that, then our transaction is balanced and the accounting equation also stays in balance. Assets went up, equity went up by the same amount. Does that make sense? Okay. Anyone on Zoom, questions? So let's look at our next part. It says, assume that the seller owes $80,000 for the land. After they received the $298,000 when they sold the land. So we're assuming that part A has already happened. We already recorded it. And now what happens next? After they receive the cash, the seller pays the $80,000 that they owe. So we've already recorded the sale of the land. Now we're recording we paid that liability. So is this a transaction? Definitely. How are our assets affected? Are they affected? They go down. Yeah, because we used cash to pay that loan, right? So our cash, which is an asset, went down. How much did it go down? $80,000. What else happened? We owed someone $80,000 before. Yes.
Liability increases.
Does it increase? Do we owe someone more money? It's going to decrease, right? It's going to decrease because we owe whoever, the bank or whoever lent us the money, we now owe them less than we owed them before. So it went down by the same 80,000. And if you think about it, if our cash went down, but our liabilities went up, we'd now be out of balance by even more, right? So if cash went down, the liability would also be going down by the same amount. And then the equity would not change. Part B here is what we call a simple transaction. There were two accounts affected. Asset went down, liability went down, two accounts affected. Letter A, we call a compound transaction because there were more than two accounts. Because we had land and cash and some equity account. So most of the transactions we deal with will be simple transactions, just two accounts. I'm telling you now, as long as every transaction balances, as long as every transaction has equal impact on the assets and the liabilities and equity, then our whole system will stay in balance. And I will be happy, and you will be happy. So it's important to think about this with each transaction. Is that balanced? Does it have an equal reaction, equal effect on that accounting equation so that it stays in balance? Letter C says, is it true that a transaction always affects at least two elements, assets, liabilities, and equity, of the accounting equation? Now, both of the transactions that we just reviewed affected at least two. Both of them affected exactly two. But is that always the case? No. No, it's not. So the answer to this question, simple answer is just no. It's not true. Can we think of an example of where maybe only assets were affected. Now we know it has to be two accounts, but it could be two assets. So can you think of just a, not necessarily related to this, but can you think of a scenario where we have a transaction and it affects two assets, but no liabilities or equity?
If the land was sold for the same amount
Perfect.
that it
So
was
what
bought.
if we, exactly. So what if we sold the land for $115,000, which is exactly what we paid for it? The land would go down by 115,000. Our cash would go up by 115,000. Our total assets would remain unchanged. We only included one of the elements, assets, two different assets, and they were affected in equal amounts, but in opposite directions. So our total assets remain unchanged. Perfect example. So no, you don't have to always affect two. Now, most of the time, it's probably true that at least two of those elements are affected, but it's not a requirement. Questions, anybody? Let's keep going then. So we're going to be talking about a series of transactions here, 9 transactions for Coda Delivery Service during the month of July. And for each one, we are asked to choose letter A through E, what happened here. So we're going to do some brief analysis of each transaction and say what would happen, and then pick the correct answer from A through E. So again, it's one of those multiple choice questions that you could just go through and pick the answers until all the green check marks appear. It's not going to help you understand what we're doing. In this part of transaction analysis and understanding how to do it and why it works is going to be very important for you. So let's look at our first transaction. Number 1 says we received cash in exchange for common stock. Common stock, I will tell you, is one of the 2 equity accounts that we're going to be working with this semester until we get to chapter 12. So chapters 1 through 11, now I'll write this on the screen for you. Chapters 1 through 11, we have 2 equity accounts. And the 2 are common stock, which is contributed capital. That means that this is the amount that our stockholders contributed or invested in our company when the shares were first sold to the public. And the other type of stockholders' equity account that we will be looking at in the first 11 chapters is retained earnings. Retained earnings is the amount of money the company has made minus any dividends so it's all the money the company has made since the company started minus any dividends. And dividends, they're the amounts that they distribute to their stockholders as a reward for investing. And I'm going to thank you. Here's some money back, right? We made some money. We're giving you part of it. So 2 accounts that we'll be using. In chapter 12, we'll introduce some additional ones. That's the stockholders equity chapter, but we'll get to that in about April. So no need to worry about that for now. So number 1 says we received cash in exchange for common stock. So we know that common stock is one of the equity accounts, and we have more common stock outstanding. That means our equity goes up. I can already pick out the correct answer here because there's only one of these that has an increase in stockholders' equity. I already know the answer must be C because that's the only option that says an increase in stockholders' equity. But let's see if it makes sense. The first part of that said we had an increase in an asset. Did we have an asset increase?
Yeah.
Yeah, we have more cash now than we had before, right? And we have more equity outstanding. Make sense? purchased supplies for cash. We talked about that term supplies last class. I said supplies are things you use in the normal course of business that get used up, but they're not for sale to our customers. And I looked around the classroom and pointed out a number of things that are supplies for me or for JCC. And they include the dry erase markers and the ink and the paper that's in the printer and the staples and Post-it notes and things like that. We're not selling them, but they get used up as we're doing business. Okay, so Marquis said, wouldn't that be A? Yeah, it would. So an increase in an asset. What asset increased? We have some supplies we didn't have before, but a decrease in another asset. What do we no longer have? The $1,100 that we paid in cash for those supplies. So yes, absolutely, Marquise, it is letter A. Paid rent for October. So we used cash. You'll notice a lot of these involve the use of cash. More transactions involve cash or our cash account, which includes our checking account. More transactions involve cash really than anything else. So we paid our rent. That means we have $4,500 fewer dollars than we had before. So we're looking at a decrease in an asset. So we've already narrowed the choices down to D or E. I guess A, because that shows a decrease in an asset, in one asset. So now we have to decide. Did it also involve an increase in another asset, a decrease in a liability, or decrease in stockholders' equity? Now this can be a little bit confusing, so I'm actually going to help you with this one. This isn't rent that we owed from a prior period. This was the rent for the current month. And so when it's the rent for this month, we're just going to record it as rent expense. The reason I wanted to clarify that is people, when you read this, it's very simple. It's very common to think, oh, well, we owed that rent, so that was a liability. But it's only been recorded as a liability, as something we owe, if it's from an earlier period. So if you find that confusing, that's okay. You'll understand it better as we keep looking at more examples. But this is the rent expense for the current period. And if you think about that expanded accounting equation that we looked at, if I can get over here to the reference materials, we have this expanded accounting equation. We can see that expenses are part of equity. Expenses are part of equity. And so when our expenses go up, our equity goes down. Expenses go up, equity goes down. The more we have to spend to make money, the less we have left. So that would be E. Cash goes down, expenses go up, which means equity goes down. It's going to be the same thing here for letter E then. We used cash and we recorded an expense.
Question number 4. For advertisement, would that be anything different if you just changed suppliers or anything? Not really.
No, not if it's a new bill. It wouldn't make any difference. The difference here would be just like I was explaining with the rent. If you received the bill last month and recorded, oh, we incurred that liability, but we haven't paid it yet, then you'd have an expense, a payable. We've talked about that word on Monday.
So it's more of an IOU type of thing?
Yes, yes. A liability would be an IOU. So if we had gotten the bill and already recorded the bill but hadn't paid it yet, and now we are paying the bill, it would be a liability going down. But this specifically uses the term expense, which tells me it's for this current period. We received the bill, we paid it in the same period. How about number 5? Received cash, $33,000. For providing that delivery services. So that must be what we do to make money. We deliver stuff. Must be we're delivering a lot of stuff because they're paying us $33,000 to do that, or either that or we're taking it a really long ways. So what do we have that we didn't have before? Cash. So we know an asset is going up. Providing delivery services, that's how we make money. We call that a revenue. And that becomes part of our income. So if we look at that expanded accounting equation here, revenues are part of equity. You'll notice, and I should have pointed this out the last time I came to this slide, the expenses has a minus sign in front of it, telling us that expenses reduce equity. Revenues have a plus sign in front of them, they increase equity. And so our answer here would be, we have an asset go up and an equity account go up. That would be letter C. Number 6 is a little bit different spin. We billed some customers for delivery services, $58,000. They haven't paid us yet. We earned the revenues, that's why we're billing them. So we know an equity account is going up, the revenue account is going up. Our equity is going to go up. But they haven't paid us yet. We've sent them a bill. On Monday, I gave you a term for that. When someone owes us money, what do we call that kind of an account?
Receivable?
It's exactly the opposite. So payable means that you owe. Receivable, that someone on Zoom just said, apologize, I didn't see the name flash. Payable means someone owes us. Receivable means, no, sorry. I said that backwards. Payable means we owe someone, we're going to pay them later. Receivable, which is what it is in this case, means someone else owes us. Specifically, this would be accounts receivable because our customers owe us for product or service that we have sold to them. That's an asset. The fact that someone owes us money is an asset for us. And so we have an asset going up, the receivable, and we have a revenue and equity account also going up. So an increase in an asset, increase in equity. That one is also letter C. Everybody seeing how this works? How about number 7, paid creditors on account? So we had purchased some stuff on account. We've already recorded that purchase. It happened maybe last month. We bought some stuff. We got the stuff, the merchandise or the supplies or whatever it was, and we agreed with our supplier, we'll pay you later. Now the bill comes due and we're going to pay it. So what happens here?
D.
Decrease in an asset. So Stephen, which asset went down?
Money.
Cash, yeah. So we spent $2,900. Our asset, cash, goes down. But decrease in liability. What's the liability?
The amount owed.
Yeah, the accounts payable, the amount that we owed to our supplier. So D is the correct answer there. Cash went down, but so did our liability. Remember back in letter 6 where we billed customers for $58,000 worth of services. Now some of them are paying their bill. Received cash from customers on account. Back in number 6, we said when our customers owed us the money, we recorded it in accounts receivable, which is an asset account. When they're paying their bill, what happens? Assets increase. So which asset increases? Our cash, right? But accounts receivable, what happens to that? What happens to our accounts receivable? Do they owe us more money or less money? They owe us less. And so what decreases is the asset, accounts receivable. So accounts receivable goes down and cash goes up by the same amount. They paid us, we have the cash, but they no longer owe us the $27,500. So let me just put it like this. So for our accounts receivable, and that's the typical abbreviation for accounts receivable, AR. For accounts receivable, back in number 6, we put $58,000 in there. In chapter 2, we'll see how do we put, what does that mean, put it in there? How does that happen? We'll see how to do that next week. But we put $58,000 in our accounts receivable, but some of our customers just paid us at least part of what they owed. And so 58,000, but they paid 27,500. After that payment, we're still owed 30,500, but it's less than it was before, right? Does that make sense, everybody? How about number 8? Oh, so that was number 8. Sorry, which one was that? So our cash went up, so we have an increase in one asset and a decrease in another asset, so that would be letter A. Cash went up, accounts receivable went down by the same amount. So in total, our assets are unchanged, but all else equal, I'd rather have the cash than the receivable. We have a whole chapter coming up on receivables. I think it's chapter 8 on receivables. And we'll talk more about the, the ins and outs and the ramifications, the business implications of selling on credit like that. Because there are definitely some concerns. Okay. Number 9 says, we determined that the cost of supplies on hand was $300 and $8,600 of supplies had been used during the month. This is one that just from reading that would be really hard to figure out what's happening here. Why did that, what are they talking about? Let me give you a little bit of a background. Remember I said supplies are mostly little things. Don't become part of the product. You're not selling them to your customer. They just get used up. And here's an example that I had given you of a supply. Pretty low ticket item, right? Now, when I just pick this up, so since our classes are on Zoom, I'm not using the whiteboard. I have tested it, and you guys on Zoom can't really see it very well if I write stuff on the board. So I don't do that. That's why I write on the screen. But I used to, back in the old days, use a lot of dry erase markers. Now, I just picked this dry erase marker up off the tray on the whiteboard, and I noticed, I fixed it, but I noticed that the cap wasn't really on tight. It was on like that. So how useful do you think this dry erase marker is going to be today if the cap's been off since the last time someone wrote on the board? Do you think it's going to work very well? Probably not. Probably not. And I'm kind of finicky about my dry erase markers. I want them to look black on the board so that people who, maybe there's a glare on the board or people are sitting in the back corner of the room, I want them to be pretty black. And so if they aren't working very well, what do? I walk down the hall to our supply closet and I just get another dry erase marker. I don't have to tell anybody. I don't have to write it down. I don't do an accounting entry to show that I've used a 37-cent or whatever they are dry erase marker. I just get one and use it. And so for most companies, this is how supplies work. You buy the supplies and you add them to the supplies account, just like we talked about up here in number 2. We purchased supplies for cash, and what did I say? The cash went down, but the supplies went up. We put $1,100 worth of supplies into the supplies account, but no one's keeping track of every time someone uses a pad of Post-it notes or a dry erase marker. And so at the end of the month, at the end of the month, we look at that supplies account and we're like, holy smokes, do we really have all those supplies? And someone says, well, no, because Cindy keeps taking the dry erase markers. And so we have to make a correction to that account. Chapter 3, we'll talk more about how do we do those corrections. But what has happened here is this company had about $9,000 worth of supplies in their supplies account. And when they actually went to the supply cabinet and looked, they said, Yeah, we only have really $300 worth. And so what they have to do is something called an adjusting entry. That will be the focus of chapter 3. An adjusting entry to get those supplies out of the asset, because we don't have them anymore. We've now used them up and they become a supplies expense because we used them up. So for this exercise, again, we'll come back and we'll spend more time talking about this later on. But for this exercise, what happens? Our supplies are going to go down and asset is going to decrease. And our supplies expense is going to go up, which means we make less money, all else equal, and our income goes down, our retained earnings goes down, our equity goes down. So for number 9, the answer that we're looking for is we have a decrease in an asset, supplies, and also a decrease in stockholders' equity because we make less money. Number 10, paid cash dividends. So we already know what one thing is happening. What's one thing that's happening? What's one account we know is going to be affected here? A decrease in an asset because our cash went down. So how about dividends? Where does that fit in? I need to get that stuff off my screen so you can see behind the drawings, behind my writing. Where does dividends fit in here? Here it is. Dividends are part of equity. And again, just like expenses, you can see this minus sign in front of it, which means really the more we pay out in dividends, the less we keep inside the company, right? So our equity goes down when we pay dividends. So the answer to our final one here is a decrease in an asset, cash, and a decrease in stockholders' equity. We make less money. Well, we keep less money, I should say. So that was letter E. I always recommend that you, at the end of the exercise, hit check my work. Just make sure you got the full 10%. You can also tell because you get the green check mark there. So if you're reviewing your exercises before you hit submit for grading, you're just going to want to make sure that your grade is the presumably 100% that you're going for if you've done all the exercises. And that if you don't have the full credit, you can tell by looking at these circles. An open circle means you haven't started it. A half and half, green, white means that it's in progress but not fully completed or not fully correct. Okay. Questions, anybody? We shall keep going then. So we know the fundamental accounting equation. We know it's assets equals liabilities plus equity. So I'm going to try to position this. We can see the whole thing. I can write on the screen and not interfere. So we have assets equals liabilities plus stockholders, equity. And stockholders' equity can be abbreviated as SE. So just change that into the accounting equation. Extend this a little bit here. Whoops. Go. So now, before I even read through the rest of the exercise, I am going to fill out the rest of the equation. I'm going to ask you to do this as well. Do it on your own. I'm going to put mine on the screen. You can do yours, and if you're using scratch paper or whatever, just figure out what the stockholders' equity was at the beginning and the end of the year, because we know how to do this. We did it last time. We have 2 pieces of the equation. We need to find the third. talking about formatting, you'll notice that there are dollar signs on the top equation and not on the one just underneath it. The dollar signs underneath it in the second equation, the end of the year, would be redundant. It's understood that if we list numbers just underneath those others that we've already said these are dollars, the ones underneath them are also dollars. So we don't need to put the dollar signs, and that will be true on our financial statements and lots of other things that we look at. Generally, you put dollar signs at the top, but then not on the numbers underneath it unless you're taking a total, unless you're doing some math operation to it. Did everybody get those same stockholders' equity at the beginning and the end of the year? Okay. So what happened to our equity during the year? Our change in equity, sorry. How much did our equity change? Did it go up or go down? It went up. By how much? $350,000. Okay. So our equity went up by $350,000. Does everyone agree with that? So what we are told here, I'm going to read what the exercise says. We have 4 different corporations, Amber, Blue, Coral, and Daffodil. And through some crazy coincidence, they all have exactly the same totals on their financial statements, on their balance sheet. And in just a few minutes, I'm going to be talking about what the financial statements are, the 4 financial statements that we do. But the balance sheet is one of the 4 financial statements. And the balance sheet really is the accounting equation that we've been working with. So it shows assets on one side and liabilities on equity on the other side, and you can see that they're equal. Okay, that's why it's called a balance sheet, because you can see that they balance, that same scale idea that we've been talking about. So all of their numbers in total on their balance sheet are the same for these 4 companies. However, the same things, the same transactions didn't occur for each of the 4 companies. So how they got from the beginning to the end of the year is a little bit different for all 4 companies. So we're asked, based on this information, plus what we just did, finding the ending equity and the change in equity, we're asked to determine how much money the company made or lost. Unfortunately, sometimes companies lose money, right? So we're asked to determine how much money the company made or lost the previous year. So let me remind you of something that I already explained toward the beginning of class. For this semester, our stockholders' equity consists of 2 pieces. Common stock, said for this semester, but I really mean until chapter 12. Common stock and retained, make that one bigger. Retained earnings. Whoops. Our stockholders' equity until chapter 12 includes only common stock and retained earnings. So when we sell more stock, our common stock goes up. We already saw that in the last exercise. I also told you that retained earnings consists of really 2 pieces. Our net income, and I'll just label it income for now, and any dividends. The retained earnings includes all the money we've made minus any dividends we paid out, because those would be earnings we did not retain. To retain means to keep it, right? So retained earnings means money that we made and we kept. Dividends are money we made, but we paid them out. We distributed them to our stockholders. So looking at this, does anybody have any questions on what I've said so far? So looking at this, what kind of events or transactions would affect our stockholders' equity? Well, it could be that we sell more stock, right? So our common stock would go up. It could be that we made money and our retained earnings would go up. It could be, unfortunately, that we lost money and our retained earnings would go down. And it could be that we paid out dividends and that would also make our retained earnings go down. So for this exercise, we know that we had an increase of $350,000 in our equity. And what we are asked to do is figure out, based on this, $350,000, and this, what makes up that $350,000, how much money did the company make? So three things that can, in general, three things that can happen to affect our equity. We sell more stock, we make or lose money, we pay out dividends. For Amber Company, Amber Corporation, it tells us no additional common stock was issued and no dividends were paid. So we're told off the bat, two of the three things that might have happened didn't happen. So the entire $350,000 increase in our equity is because the company made money. How much? $350,000. The full amount is because they made money, because they didn't sell any more stock and they didn't pay out any dividends. They kept all the money they made. Does that make sense? How about for Blue Corporation, Blue Company? No additional common stock was issued, so one of the three things didn't happen. But we paid out dividends. So the dividends represents money that we made, but we did not retain. So if we retained $350,000 and we made another $60,000 that we did not retain, how much money did we make? How much money did Blue Corporation make in total?
297.
Did they make less than their change in equity? Did they? Their equity went up by
360,000, right?
Yep. Their equity went up by 350,000, so that's the earnings they retained.
Right.
But then they made another 60,000 that they didn't keep. They distributed it to their
So
stockholders.
they added,
Yes.
the extra 60,000.
They made it. So let me put the number in here and then talk it through in reverse order, because sometimes that helps. It's kind of like guess and check, if you're familiar with that concept from math class. Estimate, and then see if it makes sense. Check for reasonableness. So let's see if this makes sense. I'm going to say it kind of in reverse order. Blue Corporation made $410,000 this year. Of the $410,000, they took $60,000 and they gave it out to their stockholders. How much did they keep? $350,000. And that $350,000 represents the increase in their equity. Does it make sense when I say it like that?
Not in the slightest. I don't get it.
Okay, well, let me say it
Probably
again.
won't ever.
Yeah, no, that's a defeatist attitude. Or as my daughter would say, that's quitter talk. So we don't accept that. If you don't get it here, you're going to struggle, for the rest of the semester. We don't want that. So let me say it, let me rephrase it. If Blue Corporation made $410,000, think of it for you. If you made $41 and you gave away $6, how much would you have left? Don't think of it in the terms of the exercise. You have $41 in your pocket. You hand me $6. How much do you have left? You're not really giving me $6. That's probably a conflict of interest. You'd have $35 left, right? Does that part make sense?
Yeah.
So now we're going to put it in the context of Blue. Blue made 41 with some zeros on it. Made $41. They gave $6 to their stockholders. They had 35 left. That 35 represents the earnings that they retained. They kept them. They didn't give them out. They could have given out all of them. They could have, like Amber Corporation, they could have given out none. they chose to give 6 and keep 35. Does that make sense? Okay, so I think I have. Let me just look. Maybe not. Okay, so I'm going to write out the relationship here. I was just looking to see if I had it in the resource or the reference materials. I'm going to write out what the relationship is here. So we start with our beginning equity. We add to it any money we make. I'm going to call that income or net income. Unfortunately, though, sometimes companies lose money. And so if we had a loss, we would have to subtract that, right? Because that would make our equity go down. If we pay out dividends, we would also need to subtract those. And then we have our ending equity. And so that mathematical relationship that I just wrote out there even if it is hard to think this through, at least at this point, you have a mathematical relationship, an equation, and if you know all of the pieces but one, you can plug in to find the missing piece. So until you're comfortable with this, until it makes sense, make a note of that equation, beginning and equity plus income minus loss minus dividends equals ending equity. And you'll be able to do exactly what we just did for that. Let's skip down to Daffodil, and I'll show you how we would use this. Our beginning equity was $230,000. Okay. We figured that out at the beginning of the exercise. Daffodil, oh, whoops, I forgot to put in the part about the stock because we didn't have that in that last exercise. Let me expand that a little bit. I apologize, I should have given you the whole thing. I just gave you what you needed for that last exercise. So beginning equity. If we sell more stock, that would increase our equity. We didn't have that in A or B, but we will have it for Coral and Daffodil. If they make money, we're going to add that. But if they lose money, we have to subtract that. If they pay out dividends, we have to subtract that. And then we'll have our ending equity. Those are the only things that can affect our equity, at least until chapter 12. These are the basic ones that affect equity. Now I can do this for Daffodil. And then I'm going to ask you to do it for Coral. So we had our beginning equity, whoops, which I erased, but it was $230,000. Daffodil says they sold some additional common stock. So even if nothing else happened, even if they didn't make any money or lose any money, they would have increased their equity by $140,000. We don't know whether they made any money. That's what we're supposed to be figuring out here. So I'm just going to put this in as our variable plus net income, because I don't know what it is. If I end up with a negative number, I'll know it was a loss. And Daffodil says they paid $60,000 in dividends. So I'll put that minus $60,000. And we know because we calculated, even though I took it off my screen, we calculated our ending equity was $580,000. So how do we solve for that variable? It's basic algebra. We're going to move all the other constants. We can combine the constants and then move it to the other side. So even if you don't follow what we're doing right now, if you have a note of this equation, you'll be able to figure out the answer. So I'm just going to combine the 230 plus 140 minus 60,000 is 310,000. So now on one side of the equation, we have 310,000 plus net income equals 580,000. And if we subtract 310 from each side, we get $270,000. The company made, Daffodil made $270,000 this year. But as I was suggesting, maybe it makes sense to talk it through and see if it sounds good, see if it sounds right. They started with $230,000 in equity and they made $270,000. So now they're up to $500,000. Then they sold another $140,000 in stock. So now they're up to $640,000 in equity, but they paid out $60,000 in dividends. So they dropped back to 580, which is what we had calculated they actually had. So those are my helpful hints. Make a note of that equation. As long as you can solve for the one missing item, you'll be able to answer this kind of question. But I would encourage you, once you have an answer, just think about, does that even make sense? And do like what I just did, kind of talk through what must have happened in the company and see if it works out in your head. If you're wondering, well, why did she skip the net loss? It's because the company can't both make money and lose money. So it's one or the other. So I knew that if I came out with a negative number, it would mean that they lost money. Try Coral on your own. Try Coral on your own. I'm going to put my answer on the screen. Oops. How do we do with that one? Excuse me.
I'm gonna talk about the class.
Okay.
This doesn't make any sense.
How'd everybody else do? Any questions on that? Did you all get $210,000? Go on Zoom. Thank you. All right, so I'll hit check my work there and we will keep going. But please make a note of that formula. And I will probably put those formulas in. Oh, just a reminder, Damon, when if you post something in, that's to the whole class, or not to the whole class, at least the people who are on campus are going to see it because I can't open the chat without it showing to the classroom. So let me walk through where that number came from. So back to what we started the exercise. We had calculated that equity increased by $350,000, right? Equity increased by $350,000. Coral says additional common stock of $140,000 was issued, but no dividends were paid. So of the $350,000 that their equity increased, 140,000 was because they sold more stock. 140,000 came from new sales of stock. So that leaves only 210,000 that's not explained. Of the 350,000, 140 was for new stock. So 210 must be from the company making money. Does that make sense when I say it like that? Okay. So just make sure that you make a note of that. Oh, how did you get to the 580? Okay. I misread your question. So how did I get to the 580? We started at 230 and went to 580. So the difference was 350. Is that where I confused you because I had erased what we had up here initially? So we had this up here initially as the stockholders' equity, beginning and ending, because it's what made the equation balance, right? And it's okay. Yeah, it's okay if it's a little confusing right now. There's a lot of information here, and it will, the more we do, it's just like anything else in the world. The more you do it, the more clear it will become. You just have to stick with it.
So the dividends are taken out after you find the net income, is that right?
For what we're doing here, yeah, so the dividends, yes, come out of net income. If I understand what you're asking, Michaela, the dividends come from net income. So the company made money, and some of it keeps and adds to retained earnings, and some of it may not keep, it pays out as dividends. So if I understand your question, yes, that is a reasonable way of thinking about it. They made money and they just didn't keep all of it. Now, some companies do not pay dividends. We'll talk about dividend policy in that stockholders' equity chapter in chapter 12. Some companies don't pay dividends at all, and you can see that in this exercise. Amber and Coral, neither one paid dividends. That's okay. There's no obligation to pay dividends. Some investors don't want to receive dividends. So what you said is a reasonable way of thinking about it, that you have your net income and then you remove the dividends or you pay dividends out of that net income. Any other questions at this point? Let's keep going then. So, and for the moment, and I may have mentioned this in the announcement on Monday, for the moment, we're going to skip over exercise 7 because most of these we have already discussed, most of the account titles. I would just remind you that the balance sheet is assets, liabilities, and equity. If we look at, fundamental accounting equation here, I'm just going to draw a line here. And to the left of that line, the accounts, the types of accounts, assets, liabilities, common stock, and retained earnings, those are what are known as the permanent accounts. Or another name for that is the real accounts. And to the right of that line are what are known as the temporary or nominal accounts. Temporary or nominal accounts. So the permanent accounts are what shows up on the balance sheet. The temporary or nominal accounts are what show up on the income statement for revenues and expenses, and dividends show up on the statement of stockholders' equity. So our balance sheet, as I already mentioned, is the fundamental accounting equation. Assets equals liabilities plus those permanent equity accounts. So revenues and expenses do not show up on the balance sheet. This is a revenue account. Dividends also would not show up on the balance sheet. All of those remaining accounts are ones that we have already mentioned, and they do show up on the balance sheet. I guess as long as we're saying that, we might as well just finish up this exercise. All the rest of those are assets, liabilities, or equity, permanent equity, and they would appear on the balance sheet. Revenues, expenses, and dividends do not, but all the other types of accounts, assets, liabilities, common stock, and retained earnings all appear on the balance sheet. Questions, anybody? So let's move on, and we're actually going to create a balance sheet for February 28th, 2023 and March 31st, so the end of 2 consecutive months. Let me point something out to you. You'll notice that all of these numbers have this Y where you'd normally have a 1 or a 2 at this time of history. That is not a real accounting thing. That is something that accounting textbooks do. And I think they do it so that as the textbooks get a little older, they still feel like they're not so old. So like if this said 2013, you'd look at that and feel like, well, that was almost 10 years ago. Why are they giving us stuff that's 10 years old? So they just use that Y or sometimes an X to represent some year. I will normally read it as if it's a 2 because we're in 2022. It is not a real thing. It is strictly a classroom thing. And I wouldn't do it if the textbook didn't do it. So you won't see me write it that way. You'll notice that there's a 3-line heading at the top of this balance sheet, at the top of this financial statement. All financial statements will have a similar 3-line heading. The first line is the name of the company. The second line is the name of the financial statement. And you know already that there will be 4 different financial statements. The balance sheet is actually the oldest, the first financial statement that existed, because companies wanted to know, what do we have? What do we owe people? How much is ours? And then we had the income statement created after that to show, well, how did we do this period, this month, this year? The third line of the financial statement is the date line. And it will either be a single date, as you see here on the balance sheet, or on the other 3 financial statements, income statement, statement of stockholders' equity, and cash flow statement, you'll see a range of dates. So it will say for the month ended February 28th, or for the quarter ended February 28th, or for the year ended February 28th. It's because those financial statements tell us what happened over some period of time. I think of it like a moving picture, a video. It shows where we were and where we are now, how we got there. The balance sheet only tells us where are we at that moment in time. So I think of it like a snapshot. You took a picture, here's what's there. So it has a single date. And we don't know by looking at the February 28th balance sheet what we had at the end of January. And when we look at the March one here, we won't know what we had at the end of February if it doesn't include those. Now, in reality, when you look at your company's financial statements, the company that you chose, whoops, for your, or will choose, if you haven't already, for your annual report project. GAAP, remember we talked about GAAP on Monday, generally accepted accounting principles. Those are the principles that we are required to follow as a publicly traded company in the United States. GAAP requires that companies prepare what are known as comparative financial statements. Comparative means that we provide at least 2 years worth of data. Many companies voluntarily choose to include more than 2 years. And so as you're working on the project, one of the questions you'll be asked a couple different times is how many years were on the statement? And the answer is never going to be less than 2 unless it's a brand new company and they didn't have anything, and none of you is likely to choose a brand new company. So you'll have at least 2 years, and sometimes they might be 3 or even 4 or 5. And as you look at each of the 4 financial statements, they don't necessarily have the same number of years on each statement. So you'll have at least 2. And they just put them side by side in columns. But all financial statements are going to have this 3-line heading at the top: name of the company, name of the statement, and the date or range of dates that it covers. Then you can see that we have our assets. We're going to list and total them. Our liabilities, list and total. Equity, list and total. And then you can see the double accounting underlined here, just pointing out the formatting things. You've got dollar signs at the top of the column, and then dollar signs when you take a total. We already know that our stockholders' equity is going to include just 2 accounts, common stock and retained earnings. It will be the same 2 every time until we get to chapter 12. And they should be listed in that order. For the assets, you'll notice it gives us a hint here. It tells us to enter the assets in order of liquidity, how quickly they can be converted to cash. So the most liquid assets are going to be listed first, and the ones that are going to be around for a while are going to be listed at the end. So virtually every company, the first account you're going to see on their balance sheet under assets is cash. Now, when you look at the company you chose for your project, or will choose for your project, their statement probably says cash and cash equivalents. When we get to chapter 7, that includes cash and internal controls, we'll talk about what that cash equivalents piece means. For this exercise, because we're using these templates, we can see that there's just one liability going to be included there. If we had multiple liabilities, we would list them all and then include a total liabilities, just like we are for the assets. List them and then include a total. For the liabilities, because there's only one, we don't need to include a separate line that says the same thing. And when we look at the information that's provided to us in this exercise, I want to point out that the first column here says February 28th, and then the second column says, you know, the end of the next month, March 31st. So you've got the older data to the left. Normally on accounting records, on accounting information, the older data is to the right. So we stick in the new column at the far left. And the reason we do that is because we, as English speakers, English readers, read from left to right. And so we want the first thing you encounter to be the newest information that's available. And then it pushes the older information off to the right. So although these are in what you might want to call chronological order, with the new older stuff first, that is not how you would typically see them. You'll notice also that the retained earnings amount is missing, right? So we're going to have to figure that out. How are we going to figure that out? Because the balance sheet has to balance. So we're going to figure out what amount do we need in there to make these numbers match. So we have cash, accounts receivable, and supplies. And we're preparing the February balance sheet right now. So we have $320,000 in cash, $800,000 that is owed to us from our customers as accounts receivable, and $30,000 as supplies. And I found total assets of $1,150,000. Is that what everyone else got? So we know this is the balance sheet. So if we know the total assets are $1,150,000, what do we also know? Is it just the equity? It is the combination of the liabilities and equity. So it's that bottom, on my screen right now, it's the bottom line. Total liabilities and stockholders' equity must be equal to the total assets. That's the equation, right? And so I can fill in that number already. Make sense? What else are we given? Accounts payable was $310,000. Well, it has that magic word payable in there that tells us, oh, that's our liability. Now, in the real world, nobody hands you a template with exactly the right number of lines and this magical drop-down menu that includes only the account titles we might want to use. We do, in fact, in accounting records and accounting software, have drop-down menus like this that list the account titles, but it lists all of the account titles that the company has created, not just a small selection. So we have a bit of an advantage, which is helpful when we're getting started. We can already tell that there's only one liability. So if we know the total liabilities and equity is $1,150,000, and now we know the liabilities portion of that is $310,000, we can also find the total equity, right? By subtracting the liabilities from the total, we're left with only the equity part. That makes sense? Now we already know until chapter 12, we already know that we are going to have only common stock and retained earnings in our equity accounts. And we know that the common stock was 200,000. So if the total equity is 840,000 and 200 of that is common stock, then we can figure out how much must be the retained earnings. Total equity is 840,000. Common stock is 200 of that. So retained earnings must be the other 640,000. Questions on that? Everything's good, I assume. I'm going to stop there for this exercise. I'm going to ask you to do the March part on your own. And then you'll be able to answer questions B and C, which is going to reinforce what we just did in the previous exercise. Keep in mind that little formula that I gave you, and I am going to post that formula in the reference materials. When I get back to my office, I'll post that, or I'll put it in the announcement possibly. Put it there somewhere. And let's move on then. I'm going to click the check my work, so it'll give me credit for the top part, and it'll remind me that that one's not done. Okay. So I'm very aware that we have only 7 minutes left in class, and I do want to be able to finish up today to keep us on track with our due dates. So let's take a look at exercise 10 next. Exercise 9 is another one of those multiple choice. You have to indicate, is it on the balance sheet or the income statement? You should already be able to do that. And even if you get stuck on one, you can use the check my work to find the correct answer. But we've already talked about what's on the balance sheet. It's assets, liabilities, and equity. And we've talked about what's on the income statement. That would be any revenue or expense accounts. So we know anything that says expenses is going to be an income statement. Anything that says payable, that's a liability. It's going to be on the balance sheet. Sales is a revenue account. That's going to be on the income statement. And then again, into the questions at the bottom. But with our remaining few minutes here, let's take a look at exercise 10. We Sell Realty was organized as a corporation on August 1st, 2017 by the issuance of common stock of $15,000. We Sell Realty is owned and operated by Omar Farah, the sole stockholder. The following statements for We Sell Realty were prepared after its first month of operations. So we're going to be able to see here examples of 3 of the 4 financial statements. The fourth financial statement is the cash flow statement. And we are really going to talk almost nothing about that at all until chapter 13, which is all about the cash flow statement. Does not indicate that the cash flow statement is not important. The reason we cover it at the end and really don't talk about it much until then is you have to be able to do the other 3 to prepare the cash flow statement at the end. So we save that till May, basically, the end of the semester, chapter 13. But these 3 financial statements that are here, you're going to know how to prepare from chapter 1. And we're just going to keep adding to what we know. We're going to make them more complicated and learn more about what's there as we work through the rest of this semester until chapter 13. So I would point out to you that there are some errors in the financial statements. And what we're doing here is answering questions about what those errors are. And then at the end, you'll be able to fix those errors. Okay? We're going to recreate the statements correctly. So as we look at the income statement, this is the income statement. We already said it's revenues and expenses. We start with our revenues. We subtract from it our expenses to find our net income. I can already see just off the bat a couple of the problems with this. Remember, I already told you about the date line. The date line for everything but the balance sheet has to say it's for some period of time, day, week, month, quarter, year, something. So I already know that this date line is wrong because it doesn't tell me, is this for the week, the month, the quarter? Now, I know it's the month because the exercise told us that. But this question, which of the financial statements displays the correct heading? Well, the balance sheet should just say the date. So the stockholders' equity one that actually tells what range of dates, which is interesting. Okay. That one also doesn't have the right date. Choice is none of that. So none of them is the correct answer. I didn't realize that was an answer. Because it should be for the month ended August 31st, 2017. That's what should appear on the income statement and the stockholders' equity statement. And the balance sheet should just have the date. Okay. Revenues minus expenses. I can also see an error here because I have total revenues, total expenses, and this, and subtracting, I don't get 25,000. So there's at least a math error there somewhere. But you can see the format of the income statement. Revenues minus expenses. We list the expenses. We do list them from largest amount to smallest amount, except if there's a miscellaneous, we generally put that last because that's usually a whole bunch of little things thrown in together. So even if it's a higher amount, we usually list that last. Statement of stockholders' equity tells us what happened to our equity during the period. So we start with our beginning balances. And this might look familiar because this is the same formula that we were just talking about. Beginning balances, we add any net income, subtract any dividends. If we had sold stock, you'd see another line for that. Sold stock, and that is an increase. And then there's the ending balances. These ending balances then come down to the balance sheet. So the retained earnings ending balance was 15,000, but here we said it was 30,000. We already know that that's wrong. What is missing? The statement of stockholders' equity should include common stock as well as retained earnings, because both of those are equity accounts. So on the balance sheet, we should have common stock and retained earnings. And it told us the common stock was 15,000. The retained earnings is going to come from whatever we made minus whatever we paid out as dividends to the owner. And we've already seen what the balance sheet looks like because we did that in the previous exercise. So we've just hit 10:40. We've run out of time, but I feel pretty confident that you are able to complete these on your own because we've talked about everything that's here. Officially, the chapter 1 exercises are due at the end of the day today. That being said, we normally would finish them during the day or during class that day. Anyone who needs more time than today, I've already explained from the first day of class, if you don't submit it, you can still keep working on it the next day. So I would encourage you to finish it as soon as you can, ideally before midnight tonight. But if you need more time, that's fine too. It's not going to close on you. It will stay open. Is there anything you want to ask about? Any questions about what we've talked about from chapter 1 or anything else before I stop the recording? All right, well, thank you all for being here.